Surely they have sold you the idea that putting your money in the bank means making it grow. But the reality is different. That is, when you make a deposit for a period of time, the bank in return gives you interest, that is, extra money. This may sound like a good idea, but behind all this lies a farce, and while you keep your money, the government steals from you with increases in the prices of goods and services. Although our money in the bank account increases thanks to the interest they pay us, this does not mean that we can now buy more products than before. In other words, you have more money than before, but the purchasing power of these bills has fallen. When the inflation rate is higher than the interest rate, it is said that the real interest rate is negative. Now you can buy fewer things than before. The opposite occurs. That is, when inflation is less than the interest paid by the bank, the real interest rate is positive. Taking this concept into account is very important when investing because your objective as an investor, whether you are a beginner or an expert, should always be to beat inflation, that is, to try to make your profits above the increase in prices. In this video, we will mention some investment alternatives that will allow you to obtain profits above inflation and, above all, forget about the banks. According to history, it was J.P. Morgan, a famous American banker, who said gold is money and everything else is credit to others. In other words, precious metals like gold are those that have value, and accumulating them generates wealth, while banknotes issued by governments are simply a means of payment. That is, they are only used to buy goods, and it is not advisable to save them because they lose value due to inflation, you know. Why do people trust the dollar? Because they see it as something valuable to save and use in the future, but here there is a problem. The American government for the last few years, it has been printing money as if there were no tomorrow to pay its expenses, whether to build a bridge or pay salaries for their employees. So what is the problem with the fact that as more bills are printed, the dollar tends to lose its value? From 2001 to 2024, the price of goods and services in the United States increased by almost 80%. But how will precious metals have fared, such as gold? During the last few years, gold has had very good returns. Now the question we must ask ourselves is, how can we invest in gold? After all, we are not interested in discovering a mine. We simply want to make money. Well, today, thanks to technological advances, you can invest in gold on your computer without leaving home. It is no longer necessary to have to buy the physical metal and keep it. A quick way to do it is to buy shares of companies that are dedicated to the gold industry. When you buy shares, you are buying a small part of the company. So if the company does well, its shares will increase in value, and thus you will make money. They usually replicate the movement of gold. In other words, when the price of gold rises, its shares also rise. An example is Franco-Nevada Corporation, a Canadian company that invests money in mining projects in exchange for receiving a portion of the income generated by the sale of the extracted metals. Another option is to invest in stocks and investment funds. This is probably the easiest way to put your money to work, as we mentioned before. Stocks are like small parts of companies that are listed on the stock market, and when these companies do well, you win money. But there is something important that you should know. Not all stocks are the same. In the stock market, there are two types of stocks: value stocks and growth stocks. Growth stocks, such as technology stocks, for example, are riskier because they focus on ideas and innovative technologies that might not work. On the other hand, value stocks like the company Nucor, which is dedicated to industrial metals, are more stable because there is a constant demand for those metals. They also have an additional advantage: dividends. These are payments that companies give you simply for owning their shares, but of course, researching all the shares on your own can be complicated and takes a long time. This is where investment funds come in, which are a kind of club where many people or companies put their money at risk. Invest so that a group of financial specialists can manage that money to try to make it grow. For example, with the money obtained, the fund decides to buy shares that are listed on the stock market. If those shares then rise in value or collect dividends, this profit will be distributed among all the companies. People or companies that contributed the initial money. These funds are ideal for average investors or those without experience in finance, because it allows you to invest in many companies without having to do all the research yourself. An example is BlackRock Grad Fund, which has a profit of 42%. It was the North American fund with the highest performance in 2023. Another very good option is collectibles. Have you ever wondered why some people invest in things like antique cars, rare works of art, handmade luxury bags, limited edition watches, or even the first edition of historical books? Well, it turns out that all of those products are collectible, and sometimes it is very difficult to understand why they sell so expensively. We could say that scarcity is the key. That is, they are products that are no longer manufactured. So if there is something old that is still in good condition, as long as there are people willing to pay for it, it can be worth a fortune. For example, with a modern car, as soon as you take it out of the dealership, the price drops by half, but with these collectible products, the math seems to be the other way around. Old cars are like wine. Their value increases with age over time. We hope you liked the video. If so, it would help us a lot if you left us a comment. Please subscribe, like and activating the bell so you can receive a notification when we upload our next video.